All right, interest rates are finally making a move in the right direction. They're kind of coming down just a little bit, but we are just ahead of the September 18th announcement from the Feds. And the decision about cutting rates and lowering the Fed funds rate should be here on the 18th. But until then, we have people that are interested in buying a house that are pre-approved that are kind of waiting. And I think that's a little bit of a mistake. And there's a few reasons why. One of them is their assumption that interest rates will be lower, so they'll end up with a lower monthly payment, which is exactly what will happen, except they're going to be met with other people that are interested in the market that have also been waiting or waiting for rates to get a little bit better. So then you have more traffic, right? You have more people that are interested in that same exact house. You have less negotiation power, less concessions from a seller, and it tends to drive the market back up a little bit. I want to show you just a case study real quick. This is a property that we started to look at with a client, and they were unpacking whether or not they want to make a move on it or if they want to wait. And so I'm going to share my screen with you real quick, and let's take a look here. So this property here on Crispy Lane, it's a nice area in kind of West Lancaster, Quartz Hill area. It's listed at $599,950. We took a look and kind of forecasted out what's the future appreciation of this particular property. So you can see the screen right here. This is using, there's two metrics. One is a forecasted appreciation. The other is historical. The historical number that we're using is actually based on a 63-year average. So if you look here, we are seeing that property, that same property there at $599,950. It is ballpark value in a year, about $627,458. Now, there's a lot that could happen in the next year. It may not hit that number, but that's the forecasted rate. So forecasted appreciation is about $27,000. If we use the 63-year average, it's a little higher. That's 5.47. That would be about 632, so $32,000 in appreciation. Now, why does that matter? Well, let's look at some of the different mortgage options real quick. If you were to buy that house today, let's say that your interest rate's in that mid to low 6 range at $599, you end up with a payment of $37.79 and 28 cents. Property taxes, insurance, all included. Cash close somewhere right around 134 and some change. Now, if you wait for rates to drop, and let's say they don't drop immediately, but they drop gradually over time, and we kind of feel like we finally hit that floor, now we're down a whole percent, we're at 5.375, and using this appreciation, this conservative number here on the forecasted appreciation, we use a new purchase price on that same house, assuming that home or a similar home would be for sale. You're buying now at $627,458. Now the rates are lower. So in this example, you save $154 a month. Your payment's now $36.24. That's exactly what you're trying to do. That's why you've been waiting. But here's a better move. If you bought it here at that $599 and you got your loan, now you're living in the house and you're making your payments. Well, then when rates do come down, so long as your financials still look good, you can refinance. Now you can bring that payment down to $34.70. You are essentially saving about $308 per month. And check this out. If you were to keep making that same payment that you did from day one and apply that 308 just to principal when you refinance, that's what this looks like over here. So we're showing you that same exact mortgage payment. We're just using additional principal reduction. Well, look what happens when we start checking out your break-even point, or I'm sorry, your freedom point. So these are all 30-year loans, except for that last one. That last one we refinanced and we took the savings and we applied it to the principal. We just took it from the interest side of things and threw it over on the principal. Now we pay off the house in 23 and a half years. We save a ton of interest over the life of that loan. Our savings over 60 months is $27,000. And our net worth increases in this scenario over 100 grand, about $150,000 versus just buying today. It's actually about $100,000 more than just waiting for the rates to drop and then entering the market. So these are examples and reasons why you might want to consider jumping in a little sooner than later, because there's good deals to be had right now. If this is a market where maybe you need some closing costs paid, or maybe you need to get the seller's attention for a specific closing timeline, maybe you want to use the seller's money to do a temporary buy down to help kind of bridge the gap until rates do hit that moment, this is the time when you can ask for it. But when all the buyers kind of enter the market and they start competing against you, now you have to bid up, 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 and there's no reason for the seller to give you those concessions, and you end up losing. You get the better interest rate, but you end up losing on the negotiation and the purchasing power. So this window of time, in my opinion, is a few months. After that, as rates start to fall, it starts to unlock more and more buyer activity, and they start preparing for their 2025 purchase, you're going to start to miss out. So this is just a quick scenario or quick case study, if you will, on a property at that 599 price point that I think actually has some more headroom. In fact, I did a study here to see what would the payment be if rates did come down versus what it would be today, and how much more headroom would you have? It was almost $80,000. So the argument of, well, if rates do come down, the values you're going to have to come down. That's not true, because if somebody's buying in this market, and there's plenty of buyers out here in the market right now, anyways, they would have enough headroom to increase the value of that property even further. So that forecasted appreciation, I think, is actually fairly conservative and probably spot on. Time will tell. We'll look back at this maybe in a year and see exactly where those numbers were. But if you have any questions on the market, specifically on a specific property or your strategy, don't hesitate to reach out. This is really fun to do some planning around it. We run these case studies all the time, and sometimes we see that it's a really good deal. Other times we find out it's not so good, and maybe we want to hit the pause button or look at a different property. But there's ways to win in this market. So look forward to talking to you, and hopefully I can share some of these strategies with you. All right, till next time.